Welcome back. I'm Dhesi. First one back after Easter. Markets did not take the break. And here's what matters this week. Last week was one of the more volatile weeks I have tracked in a while. Stocks rallied Wednesday as de-escalation headlines built. Oil surged Thursday after Trump said there would be no let up. And by Friday, markets were finding a floor. And today, cautiously building higher on a fresh peace proposal. That is the frame, not a clean trend, not a clear resolution, a market oscillating between two scenarios and not fully committed to either. Sitting underneath all of that, Friday, US CPI for March, the first inflation print since the Iran war began, and that is the number that clarifies the picture. At Harvard on the 30th of March, Powell was direct. The tendency, he said, is to look through supply shocks. Energy price spikes driven by a conflict have historically come and gone faster than monetary policy can respond. But he attached a condition, a critical, essential aspect. In his words, is carefully monitoring inflation expectation, because if businesses and households start building higher prices into their forward planning, the rationale for looking through disappears. So Friday's CPI is a test with two parts. Part one, the headline, energy will push it higher, and that is already known. Part two, whether core holds and whether Michigan long-term inflation expectations shows any drift. That is a real test. Rate cut expectations for 2026 have been coming back into market pricing following Powell's comments. A significant shift from 2 weeks ago when hike probabilities were climbing. Wednesday's FOMC minutes tell us whether that read is correct. On the 1st of April, Bailey gave an interview to Reuters at the Bank of England's London headquarters. He was unusually direct. Markets are getting ahead of themselves in pricing in rate hikes. JP Morgan revisited its Bank of England forecast within hours. 2 hikes this year, down to 1, expected for July. Bailey's logic is worth understanding. He acknowledged that inflation risk from energy is real. Some pass-through is likely, but the labour market is softening. Activity, he believes, is running a little below potential. Businesses tell him consistently that they have limiting pricing power. And that combination, inflation risk on one side, growth drag on the other, is why he is resisting the push towards aggressive tightening. Practical read for the rates desk, Bank of England hike pricing has pulled back sharply. April the 30th is now framed as another hold. June is the first serious live question. So Wednesday last week, stocks rose, oil fell. Thursday, Trump said no let up, oil surged sharply. On Friday, there was stabilization. Today, cautious construction on a fresh peace proposal. I've watched this long enough to know the pattern. The headlines oscillate. The physical market does not resolve as cleanly. Saudi Arabia charging a record premium on its crude. That is a market pricing sustained disruption, not imminent resolution. And even if a ceasefire lands, how quickly shipping through the Strait of Hormuz and the Gulf energy flows actually normalize is a separate question, with its own timeline. These things do not step back overnight. Brent at $107 per barrel, risk premium has compressed. It has not been priced out. So rates from Friday, dollars 2-year at 3.9%, 10-year at 4.15%, and the curve is positive. FOMC minutes, Wednesday, 6 p.m. London time, and that is the first real signal of the week. How unified is the committee behind Powell's patient framing? If there is dissent, more hawkish voices inside, the 2-year moves before CPI even arrives on Friday. So do not wait for Friday if you have rates decisions in front of you. Sterling swaps, 2-year at 4.43%, 10-year at 4.59%. Bailey's pushback is the dominant Bank of England signal heading into April 30th. Euro swaps, 2-year at 2.8%, 10-year at 3.04%. The ECB also on April 30th. Hike expectations pulled back from their peaks. For Treasury teams managing floating rate liabilities, the window before Friday is the clearest signal since the conflict began. Two channels this week. Let's go dollar first. Euro dollar at 1.154, cable at 1.32. So dollar is softening on two things simultaneously. Ceasefire hopes, reducing the safe haven bid, and Powell's patient stance, reducing near-term rate urgency. When both tailwinds work against the dollar at once, the move extends further than the individual parts suggest. But Wednesday evening is the pivot. Hawkish FOMC minutes, dollar gets a bid back, and that will be fast. Watch the minutes before making FX calls for the rest of the week. Sterling above 1.32, Bailey signal took the hawkish premium out of cable. Next move in sterling is more likely to come from US data this week than from UK events. Hot CPI, cable goes lower, soft CPI, relief trade continues. So Brent at $107 per barrel, and that's down slightly today, up more than 5% over 10 days. Saudi Arabia's record crude premium is the cleaner signal than the intraday moves. The physical market is pricing sustained disruption. Gold is at 4,653, and that is up nearly 5% over 10 days. Gold and equities rising together does not reflect conviction. It reflects a market that wants risk, but is not confident enough to exit the hedge. So watch gold if de-escalation accelerates. A genuine resolution brings a safe haven premium out very quickly. The S&P 500 at 6,611, 5-week losing streak, broken last week. Euro stocks 5,734, that was up 2.4% over 10 days. The Nikkei at 53,900, up 0.59% over 10 days. But to be honest, about the character of this rally, it is tentative, not conviction driven. Follow through into hot inflation data this week tells you whether there is a genuine confidence behind it. US investment grade 86 basis points, US high yield 313 basis points, Euro high yield 326 basis points. Jamie Dimon warned this week private credit losses will be larger than feared, not a crisis signal, a caution flag. Watch high yield as earnings seasons opens next week. Bitcoin just under 70,000, up 4.4%. High beta read on risk appetite in real time. A well-populated data week. On Tuesday, there's US durable goods orders, and that is your early read on business sentiment. Wednesday, the most important day before Friday, FOMC minutes at 6 p.m. London. And that's the Fed's internal debate on the oil shock, and rate path lands here first. Also on Wednesday, the RBI in India and the RBNZ in New Zealand, both secondary. The minutes are the dominant event. Thursday, US PCE prices, Fed's preferred inflation measure, drops 24 hours before CPI, and that sets the tone for Friday. So on Friday, US CPI for March, core and headline, Michigan consumer sentiment and long-term inflation expectations alongside the standout event of the week, and that is the first post-war inflation print, and that resets the expectations for the May Fed meeting. And Michigan long-term expectations, the test of whether Powell's patience has room to hold. And above all of it, Iran. Any headline can move Brent and the dollar faster than any scheduled release. Keep it in the frame all the week. That's your week ahead. Bookmark it, come back Friday, see how it aged. I send a daily version of this every morning on Telegram, and the free link is below. Subscribe if you want the next one, and drop the one level you're watching down below.